My name is Dave Ripplinger, bioenergy, bioproducts, economic specialist with NDSU Extension, moderator, host, troubleshooter most of the time of our monthly webinar that focuses on current markets. Agricultural market situation outlook is presented monthly. We had a few special tariff editions in April. I don't know if we're going to have any more of those, but there's definitely enough news and things to talk about at a pretty regular pace. This is being recorded, will be posted to NDSU's YouTube channel end of tomorrow, sometime early next week, so people can access it, come back to it if you'd like. We are happy to answer questions. We do have a bit of a changed agenda based on our compared to our regular schedule. So Professor Olson is going to go first. Happy to answer any questions. And then actually Byron Parman, who usually kicks things off, will be at the tail end of things today. Please ask questions using the Q&A tool or the chat tool if you'd prefer. We're happy to get to those. It adds a lot to the discussion. So with that, I'll go ahead and hand it over to Frayne.
All right. Thank you, Dave. And today I'm actually traveling, as you can probably tell by my background. I'm in eastern Wisconsin at some meetings and speaking at some conferences here. So I was able to get everything updated. Unfortunately, after my session here, I'm going to have to try and duck out and beat it back to Fargo as quickly as possible. I got some programming tomorrow. So if there are any questions that you have, please make sure that you type those in. As I'm presenting my material, I'll hang around for a few minutes at the end of my session to try and answer any questions there are. And then I'm going to have to duck out and try and make it back to Fargo tonight. So let me share my screen. Thanks for attending today. This is my contact information. If you do have some questions that you want to talk about privately afterwards, more than happy to try and do that. Again, I do have a heavy travel schedule, so please be a little bit patient with me. I'll get back to you as soon as I possibly can. So here's my email address as well as my office number and my cell phone number. So let's dive right in. We did get an update to the WASDE, the World Agricultural Supply Demand Estimates, as well as an update on the production numbers, primarily for wheat. For the WASDE part, they was slightly positive for corn and wheat, basically neutral for soybeans, just as you'll see in a few minutes, really, really small changes to our supply and demand and kind of ending stocks numbers. I'll go through those in just a few minutes. There have been some updates on U.S. trade and tariff policies. I will continue to try and provide those updates at a minimum during our monthly sessions. If there's something major that occurs, we might have to schedule a special one. But this is a very, as they say, fluid situation. It's changing continuously, so I do my best to try and keep up with that. I'll talk about those as well. The other part to the other issue with these trade negotiations is please always remember that agriculture is part of the discussions, but it's not really the core contentious pieces to it. Okay, so agriculture is getting pulled into the turmoil of the trade and tariff policy issues. It's part of the negotiation, the discussion that's going on, but it's not necessarily the focal point. It's not something that is really driving all of the discussion. So you have to keep that in mind. So let's go through the numbers. This is for old crop. So we're at this funny stage of the year where we're looking at some old crop numbers as well as some new crop numbers. So this is the information for last year's marketing year, for the crop that we harvested last year and we continue to sell and market throughout the rest of the season. So we're coming to the end of the marketing year for wheat, and so we really don't expect any major changes. Just for everybody's reference point, the blue line on our blue row on the very top is the average trade estimate. The black line towards the bottom is in bold is the information we got from last month. And of course, the red numbers on the very bottom are what we have from the report out today. So for all wheat, really no changes. And we were not expecting any changes because, again, we're getting at the very end of the marketing year. The marketing year for wheat ends in the end of May, beginning on June 1. So we're just right now, USDA is kind of tallying everything up, making sure that all the numbers are adding up and are finalized, and we'll be moving forward from there. Now, for old crop corn, there was a small increase, about a 50 million bushel increase in export sales. Again, the USDA numbers are now catching up with the weekly reports that we've been getting. So again, they're making some adjustments toward the end of the marketing year. Marketing year for corn and soybeans end in August, so we do have a little bit of time left. So we did see an increase in the forecast for total exports for this marketing year for the old crop, which then took our ending stocks down because we're not negotiating or not arguing about the production numbers anymore. For soybeans, there was no change. So for old crop soybeans, we didn't see any change, but we did see again some slight adjustments. So slightly positive news for the corn market. Okay, moving to new crop. So now this is the crop that's in the ground right now, beginning to grow. So we have a lot of forecasts. There's a lot of room for negotiation and room for update as we move out through the rest of the production year. Again, the blue, highlighted blue on the very top is what the trade was expecting to see. When we look at the highlighted black is what we saw last month, and the very bottom line is what we saw this month. So looking at the wheat numbers, the trade was not really expecting any adjustments or shifts. However, we did see a slight increase in the forecast for new crop wheat exports, about a 25 million bushel increase, which then, of course, dropped our ending stocks numbers down slightly. So again, slightly positive for wheat. For corn, they weren't expecting, again, the trade was not really expecting any adjustments. And for the new crop numbers, if you look just at the new crop, there really weren't any adjustments. So the reason that you saw ending stocks for new crop go down was because the old crop numbers from last year carry forward into the new crop calculations. So this 50 million bushel decrease in ending stocks was really because of the increase in exports for the old crop numbers. So it's from last year moving forward into this year, and it starts to filter through our system. Again, for soybeans, no change. The trade really wasn't expecting any major adjustments, but we essentially got no change. Shifting to South American production, the Argentinian corn crop is getting close to the harvest process, actually just ending up with the process. The safrinha corn crop in Brazil is in the middle or late stages of development right now. So we are looking at those numbers. USDA didn't change anything in their forecast for production or consumption of the Argentine or Brazilian corn or soybean crop. So again, no change here, really no adjustments in the story. And then finally, we did get some updates on wheat production estimates. Now, these are primarily for the winter wheat classes, not for the spring wheat classes. So this does not include any spring wheat or durum, or any like hard white spring wheat. So the white wheats that are listed in this is primarily the winter variety. Again, the trade was not expecting any major adjustments. We really didn't see any major adjustments, just some small tweaks. There was a small, tiny reduction in hard red winter wheat production with a small increase in the white winter wheat production. So at the net was very small changes. I mean, just nibbling around the edges, nothing really substantial. So the information we got today from USDA reports, pretty neutral. Again, slightly positive for corn, slightly positive for wheat, but nothing earth-shattering. Now, I do want to shift into some updates on the trade front. Most of the intention over the last several days has been with some progress dealing with the Chinese. So there was a mutual agreement because if you remember right, we had this tit for tat or this escalation of tariffs between the United States and China, got to some exceptionally high numbers, 145% for the U.S. on Chinese products and 125% from China on U.S. products. There was an agreement in Geneva. President Trump, President Xi of China got together. They said, okay, let's bring this back down. Let's start having some discussions. So there was a 90-day pause in those escalation of tariff discussions, or of basically tariff escalation. So August 12th will be kind of the critical date in the U.S. and China trade negotiations. We did have some of the some disagreements. So the agreements that were made in Geneva between President Trump and President Xi were very broad and very kind of nondescript. So there wasn't a lot of detail behind that. And so as we move forward in time, there got to be some disagreement on exactly what was said and what was agreed to in Geneva. So we came back. There are some additional discussions between top trade negotiators in the United States and top trade negotiators in China. They met in London over the last 3 days. What they agreed upon was a framework. So they agreed that the framework that was set forward in Geneva was I guess more formalized. They started negotiating and saying, okay, what does this really mean, and what did we essentially agree to? So we made some progress, but again, the progress was relatively slow, and this framework is relatively still loose. I'll talk about that in more detail in a moment. Now, this framework still needs to be approved by both President Trump and President Xi. The current thought process is that will occur. So what was actually agreed upon? Well, the Chinese agreed to reduce their export restrictions on rare earth metals as well as magnets. So these are specialized magnets that are usually often used in electric high efficiency electric motors. The Chinese have some basically a corner on the market for a lot of the rare earth minerals. And so most of the discussions revolved around what are the Chinese going to do, and then also what are the U.S. going to do. So right now, the U.S. still has tariffs on any products coming in from China. And actually, when you add them all up, there's a 55% tariff rate. So even though we've gone from 145 back down to 55, that's still a significant reduction. There's still the 10% baseline reciprocal tariffs that was announced back in June. Or in April, excuse me. There's still the 20% fentanyl tariffs. Those are still in place. And there's 25% tariffs on most products that President Trump put in during his first term. So there's still some pretty heavy tariff rates for Chinese products coming into the U.S. Now, the Chinese have an additional 10% on U.S. products. So based on their normal tariff regime for example, with soybeans, there's a 3% import tariff on all soybeans coming into China, whether it be from Brazil or from the United States. They're adding an additional 10% on U.S. products. So right now, the U.S. soybeans are at a 13% tariff, and the Chinese purchases from Brazil are at 3%, excuse me. So there's still this discrepancy, there's still this disparity, but at least we've come to more of an agreement and more consensus on exactly what we're going to do and what the path forward might be. So I want to be very clear, we do not have a formal trade agreement with China. So there's a deal in place, but it's really to try and bring the rhetoric down to make sure that as we progress in these negotiations, everybody has this baseline of what are we talking about, what are we negotiating, and what is the steps for as we move forward. So just to provide a brief update on a few changes, Japan, we're in round 5 of the talks between the United States and Japan. We already have a bilateral agreement between the U.S. and Japan. We're renegotiating certain provisions within that agreement. A lot of that has to do with some non-tariff barriers, as well as the tariffs on automobiles, semiconductors, ships, as well as a few ag products, not rice. The Japanese are very particular about their rice, and they want to protect their domestic rice production. So we don't, again, have a lot of details. We do know that the negotiations are continuing. There has been a little bit of chatter now with U.S. and Mexico. Again, there are some direct negotiations between U.S. and Mexico going on. The 25% tariffs on all non-USMCA, those U.S.-Mexico-Canada agreement products, are still in place. The steel and aluminum tariffs went from 25% to 50%. Current reports suggest that there has been some negotiations for steel and aluminum, for Mexican steel and aluminum coming into the U.S. Again, it's a little bit vague, a little bit uncertain. It sounds as though like there might be a quantity, what they call a non-tariff or a tariff quota rate, meaning that there will be some steel and aluminum coming in from Mexico that will have either no tariffs or very low tariffs. But as that volume increases, the tariffs rate will start to increase. Again, not a lot of detail, but at least it sounds like negotiations are moving forward. With Canada, again, very similar to what we had before. Last time I talked about this, the primary changes that steel aluminum tariffs went from 25% to 50%. So far, Canada has retaliated on selected items, including a few ag items, but they're not really major items that we need to be concerned about. So discussions are ongoing. We'll obviously have to try and monitor that as we move forward. The UK, I talked about this last time. There has been some movement with the United Kingdom or Britain. We're moving forward. Negotiations are continuing. The European Union, I think, will be one that we're going to be talking about and listening to more closely over the next several weeks. There's going to be more deep and focused negotiations with the European Union. Those negotiations are going to take some time because that's a really complex set of negotiations, as well as there's 27 countries within the European Union. So it takes a lot longer for that group of countries to be able to come to a consensus on what the changes might be. We made some progress. We're still in negotiations with India. Again, there's been some terms for reference. We know what we're discussing, but there haven't been, to my knowledge, any formal agreement signed. I do want to talk just a little bit about the weather and what's going on. Obviously, politics and the weather are the two biggest things that impact grain prices. This is the most recent drought monitor map. You do see some pretty dry conditions in a lot of Nebraska, parts of South Dakota, western North Dakota, and into Montana. These are the areas that we're focusing on and worrying about right now. Obviously, the weather forecasts are changing on a daily basis, but the National Weather Service did put out their estimates or their forecasts for both precipitation and rainfall for the upcoming month of June. This is for precipitation. Looks like equal chances of precipitation here in eastern North Dakota, probably a little bit below average precip in western North Dakota. Again, those drier areas in particular northern Illinois and parts of Iowa, it looks as though there's kind of an equal chance. At this time of year, those regions do get quite a bit of rainfall. So I'm not really worried, and I don't think the marketplace is terribly worried about rainfall into the heart of the Corn Belt. We will be watching what's going on in Nebraska fairly closely. From a temperature perspective, it looks like June will be an above average temperature. At least that's the best chances of our above average temperature here in North Dakota and Minnesota. About equal chance as we get into Kansas and Nebraska, so we'll have to watch what's going on there. So with that, that's the end of my presentation. I will stop sharing and I will take a short pause to see if there are any questions before I hand things over to Tim Petry for his livestock outlook. And I'm watching the chat as well as the Q&A. It doesn't look like there's anything that's come in, so I'll wait for just another minute. And again, just want to thank everybody for your participation in these programs. I will do my best to respond if there is anything that you might have later. So again, as I said earlier, I'm going to have to drop off because I have a long drive back into the Fargo for my meetings tomorrow. So with that, I will hand things over to Tim.
Good afternoon, everybody. Tim Petry, Extension Livestock Marketing Economist. My contact information is shown there. Seems like kind of a broken record for those of you that know what phonograph records did when they stuck. They kept repeating themselves, and also from a record standpoint, we're breaking records. But, just a continuation of what I've been talking about the last several months. The cattle market just continues to go up and up, with shorter numbers of cattle anyway, not necessarily meat production, beef production, I'll talk about in a minute. So here's my charts again, all color coded the same. Red is this year, the light blue last year, and 2023 in purple, 2022 in green. So you see cyclically we've been going up every year, and really strong here the last few weeks especially, and over. Interestingly enough, I can't put all those lines on my chart, but if we go back to 2020, at this time, fed cattle were $95, and last week they were $236.62 was the 5 market average this week, trading steady to up, trading as very, very few have traded yet, but some even up to 244. So just going very, very strong. Demand remains very, very strong. I'll show you the cutout value in a minute, but very strong. But, you know, we're expecting cyclically higher prices, obviously, this year and into next year as well. But that doesn't mean that prices can't go down, because we have that seasonal pattern that usually occurs. And you see the red squares there. The futures market is saying now that we're probably getting kind of toppy here, and probably will go down into July, August, and so on, like we do. And we did last year. And I know there was concern last year when the market started falling, but that's a normal seasonal thing and kind of expected this year. As far as next year, those gold squares there, the futures market is now risk off and, you know, showing lower, but a lot of things can happen. Of course, the biggest thing is, you know, Frayne mentioned, the biggest concern is really tariffs, and then on consumer demand. And so anyway, just kind of interesting that beef production, and I didn't bring my chart to show you the increase in carcass weights and so on, but beef production, you know, the first 4 months of the year was about the same as last year, and yet we have higher prices. So that means the only way that can happen is that we made it up on demand. So, you know, I've been saying in all my meetings, when the fundamentals in the cattle industry, when the fundamentals are good, they all seem to be good. And when they're bad, they all seem to be bad. There isn't a happy medium. And just fortunately, at least those for selling cattle, you know, they're all good right now. So a little bit more on demand then. Here's the box beef cutout value, and that's what packers can sell beef for. And you see the demand is really, really great. Again, that does tend to level off this time of the year, because they're buying for the retailers are buying for the 4th of July right now, because they have to get the process in the works. And after the 4th of July, you know, we're through Memorial Day, and, you know, Father's Day is already buying, is another big beef day is behind us. So they're buying for the 4th of July. And then we have to wait all the way, you know, maybe a little bit of bounce there for Labor Day, but not much. So anyway, probably peak about, but that cutout value, again, all-time record high as fed cattle are. This morning, you know, last week, the cutout value was there at you know, 364, whatever. This morning, the cutout value had popped up from yesterday, another $2.50 up to 377, which would be at the top of that chart for you know, this morning's. And so beef is moving very well at record high prices, and, you know, it's just really good for prices for those selling. The other side of demand is the export demand, and we've talked about tariffs and so on before, but again, looking at the red line there, this is the U.S. beef and byproduct export value in millions of dollars there. And you see the first 3 months we were about the same. In March, we're always we just got this a few days ago. We're always 2 months behind in getting the data, but we did back off on export value into April, which was expected, and it's all because of China that Frayne also talked about. Japan and Korea are our 2 biggest customers, and they both increased what they what we exported to them last month. And China's our 3rd. We dropped off 70% in exports to China last month, and now that's by when the May numbers come out, and now we're at 0 into China, because they have not approved. You know, the tariff rate is like 37%, which we would still probably be able to move some in, but they have approved no packing plants or cold storage facilities for beef moving to China, have not approved them this year, although they did for pork, but not for beef. So we're just not allowed to ship any to China. So that's why this number went down. Also, then we look at number 4th place, Mexico. They also increased, and Canada is the 5th place. They stayed the same. So we were either up or the same, and all our customers except China down dramatically and even more so. But again, we're doing very well on prices without China. Probably if China was in there taking what they were before, we might even have higher prices, interestingly enough. Yeah, Frayne mentioned the drought monitor, and I'm going to get into feeder cattle now. And the USDA, when the drought monitor comes out on the bottom, they put out a corresponding chart that shows the number of cows in drought and so on. Unfortunately, they didn't get it updated, so my drought monitor is a week off, the one on the upper left-hand corner. But all I wanted to do in showing this is go back to last fall, October 22nd, on the right-hand side, upper right-hand side. That's how dry it was from Texas all the way up through most of North Dakota, particularly western North Dakota. Again, the top cow-calf and calf states starting go right up from Texas, Oklahoma, Missouri, Kansas, right on Montana, and North Dakota is the 8th place. On the bottom right-hand, you see the dark color there, where that is. And so what's important is, 59, almost 60% of the cattle were in drought last fall. But we have had major improvement in a lot of cattle country. Frayne mentioned Nebraska and South Dakota being dry, and western North Dakota, but a lot of Texas and Oklahoma and up into southeastern Kansas, and then also Tennessee and Kentucky are big grazing states. California over there in Northern California, they graze a lot of calves. So one of the things that sparked calf prices is that weather has improved in a lot of cow country, and we are short of cows, went down 6 straight years. So that means that there is, in some cases, excess grass. So they want calves. On the bottom, you see 25% of the cows were in drought as of last week. And so not only are we in short supply of calves, but the weather has improved, so there's a bigger demand. And then the other thing that I'll show you in a minute is that we aren't getting any from Mexico. So again, following along with fed steers, here's calf prices, all-time record highs, the same stories on fed cattle. But again, they do go down in fall. I just want to remind you they're probably peaking seasonally here in a little while, and they'll start going down. And that isn't some conspiracy of something irregular happened at all. It's a normal seasonal pattern as marketing picks up. Last year, they went down a little bit earlier than they do sometimes because it was so dry down south that the calves moved earlier, but still they're trading well above last year and expected to be above last year all the way through fall, even though that they decline. And again, it's short supplies. And then the 3 biggest things that affect calf prices are the supply, which we know is going to be lower this fall because our calf crops continue to be down, and then corn. And Frayne just mentioned corn. USDA is still holding at an average price of $4.20 for corn for this year, down 15 cents from last year. So that's supported the fall calf prices, and so low supplies in corn. Moderate corn prices, and then fed cattle prices, particularly those distant futures when the calves would reach market. Again, all positive for calves. Another thing then that's affecting the supply of calves is that, again, we have shut off the border to Mexican calves. Right now, we would probably be getting, if we look at averages, or last year, we'd probably be getting 15,000 or so calves coming in from Mexico to graze on those improved conditions in Texas and Oklahoma and Missouri. And because of the New World screwworm, the border is closed, and not knowing when it's going to open. Way down in the bottom right-hand side is the drought monitor for Mexico, and they are very, very, very dry there as well. And so that might mean that maybe even a few more calves would come if possible. But as of now, there are no calves coming in from Mexico. Go to the heavier weight yearlings, then the same thing all time. Oh, and the other thing I wanted to mention on calf prices is I use an average price here. The average price North Dakota last week was $4.10 for 5 to 6 weight calves. But there were calves selling up to $4.40, but also down some maybe at $3.80. So there's that wide range, and So this is just an average, but again, record high. Fed steers the same way. Last week averaged 325, but we had them trading all the way. I saw a market report where one lot of really good ones, I think, went up to around 350, so a wide range there, but still at record high levels. The futures market is about, the nearby futures is August. They're at 310, just a little under what the cash price in North Dakota is, but we have a positive basis up here anyway, so that would put our 750 to 8 weight steers about the same prices there. Now again, futures market for next year, like fed cattle, is a little risk off. It's a long ways out to predict and what's going to happen to corn and everything else, but certainly now it looks like better prices for the fall than last year, unless we run into a lot of tariff problems or some other thing happens. So I just end up then, like I mentioned, the futures market has just continually went up with the cash market. The green line is the CME cash index, which the futures market settles out is all-time record high. And this was yesterday's chart at 311 on the futures, and that's about, I haven't checked lately, but they were about unchanged the last time I looked at all-time record highs. But again, there's volatility, and you just go back to, there in the middle of May, we had a couple of real bad days down in the futures market, and that was just a false rumor out of Missouri that screwworm was already found in Missouri, and they quickly got rid of the rumor. But the market really gets to the jitters when it's at high levels. So I'm saying, like for summer grazing programmer, when we get into fall backgrounding, maybe looking at some price risk management, LRP or something still might be something to consider, because a lot of things can happen with all the geopolitical and so on. And there is really a lot of interest in LRP. This year we're going to do an all-time record number of LRP. The LRP year actually starts July 1st to June 30th, but this year we've already in North Dakota have contracts for 250,000 feeder cattle, so a lot of interest there as well. So, and one improvement on LRP that's going to go into effect July 1st is now those people that contract calves, say a feedlot contracts calves for fall delivery, and before they or whoever it is, they couldn't buy an LRP contract until they physically had possession of the cattle. But there's a new change there, that as long as you have put money down to buy cattle, even though they won't come to your place in October, November, whatever it is, you can now do an LRP contract. With that, again, a lot of volatility. So price risk management, don't throw it out the window, because, and there's risk on a seasonal basis as well, like I talked about. So I'll finish up lamb prices. Fed lamb prices are just unbelievably the same as last year, week by week by week. But again, remember that they usually do kind of top off now and start to decline. And no surprising that the same, because lamb production is about the same, and the lamb cutout value is about the same as last year, and imports of lamb are about the same as last year. So everything about the same. So with that, I'm stopping sharing and turn it over to Dave.
Great, thanks, Tim. Covering a few things here, from what's going on in the bioenergy space. It's actually some big news. Last week had the highest recorded level of ethanol production in the United States, touching and exceeding a number from late last year. If you look at the chart, you can see there's been a bit of a upward movement. Production took a bit of a dip for a little bit, and part of that was just making up that space. One question that it might lead to in terms of excess production is, like, where is this going to go? If we look at the amount of gasoline being supplied to the market for 2025, it's actually relatively similar to the last 2 years. This only goes through the first half of the year. But again, fairly strong numbers. And again, if we think about things like fuel economy and changes in travel behavior, that's a really good sign generally for ethanol. If we look at the blend rate, and again, this is looking at the amount of gasoline that went into the market and the amount of ethanol that went into refining blending, we see this number above that 10% line, or what you think of like an E10 line for the country. And again, this is a signal that we'd be looking at, that E15 and E85 having relatively strong market penetration, which does somewhat match what we've seen in the market. It'd be interesting to see more refined data that really looks at those specific sales, especially at a state level. Tremendous interest in the corn and ethanol industry to see that year-round E15 come into play. We'll see how that plays out. Then also too, just looking at exports, again, where might this ethanol be going? Exports remain strong. Often, definitely moves up or down considerably based on if there's a sale in a given week. Close to exceeding what we saw last year, which was a record year for corn ethanol productions. And this does go through last week. So any trade dispute related disruptions, really don't come up in the data for this. Finally, just a couple of things regarding policy. So the first on 45Z. So 45Z is a tax credit that incentivizes the production of low carbon fuels, including biofuels. A lot of interest in it from the biorefining industry, as well as from agriculture producers. Again, providing this incentive to increase production and or shift production into practices that have lower emissions, and a lot of interest in that on the farm production side. A piece of somewhat related news in terms of 45Z is that an updated version of GREET was released just last week that has additional biorefining capacity. I think this is a signal that folks are still working on it. One of the questions with the change administration is how much interest is there in this program with the change in administration, change in priorities and interests. We also saw late last month in the House Reconciliation Bill an extension of 45Z from its original ending date at the end of 2027 to 2031. Again, providing a much bigger window. And this is a positive signal in a couple of ways. One, that it's being brought up and it's extended. But if you think about investments that folks might have to make, maybe first at the biorefinery level, but also at the farm level, this provides, if this became law, a longer window, a longer runway for these practices, these investments to be made. Also looking at some other news, USDA did announce last month that they will be continuing some climate smart commodity partnership programs for those who had at least 65% of their budget going to farmers. For those who had signed up a farmer and had paid a farmer by the end of last year, they would be eligible to continue on in the program. Additional information be coming up, reporting requirements and such by the end of the month for folks interested involved in that. Just kind of a pin, relatively speaking. There's a lot of interest, enthusiasm, impatience, waiting for renewable volume obligations from EPA for 2026 and beyond. And again, remember, renewable volume obligations are those levels of fuels that need to be used in the United States. And a lot of interest, particularly on the biomass-based diesel side. And that really relates to our ability to produce both biodiesel and especially renewable diesel. The levels now are below where the market's actually at. And the intent of the RFS was to provide or help build that market. If the supply was there, the RFS was there to ensure that there would be a market for it. And then finally, the last thing, which is to me is rather interesting. We're looking at a variety of things going on now. So we have reconciliation going on. We have planning for the 2026 fiscal year for the federal government. We also have the Farm Bill on the line. The House Reconciliation Bill that passed last month includes language that would bring the $13 billion in NRCS funding for what was then climate smart practices, bring that into the baseline for the Farm Bill, and it would remain within NRCS, but it would remove that climate type language, but a rather large increase in the size of the baseline if that became law. And again, this would provide additional legroom within NRCS then to provide funding for those services. I'm actually going to skip that slide. I'm going to stop sharing because I know that Brian is next. We're not done like usual. Again, please ask any questions. We'll get back to me in just a little bit. And as soon as Brian can come online, he can have the floor.
So I just wanted to I haven't done a macro update in a few months. And one of the things, they've been talking about, obviously, there's a lot going on, not just in the agricultural economy, but the macro economy related to trade and tariffs and what's going on with interest rates and growth and those kind of things. So I just wanted to do an update at the beginning of the summer, just kind of to show you folks where we're at and sort of the projections over the next few months, which is kind of ambitious given how fast things have changed week to week and sometimes even within the same week. So just a couple of things from the news this week related to inflation mainly. And one of the things that matters a lot with inflation is what most investors and just folks in the general economy expect to happen with inflation. If you've heard any of my discussions before related to inflation, future expectations often influence current prices. In other words, if people expect inflation is going to continue or perhaps increase, they may tend to go out and buy more things, which then basically increases inflation, and then the reverse is also true. But one of the things that's happening, at least happened in the most recent survey by the New York Fed, is inflationary expectations for the foreseeable future down to 3.2%. That's kind of what the benchmark that they're saying. That's higher than inflation actually is, but what that basically reflects is that folks are less concerned that tariffs are going to push prices higher. Okay, so it's one thing for uh, folks like myself, other economists, to talk about what tariffs may or may not have as far as an impact on prices. But what is the general population? What does the public actually think, and how are their behaviors changing based on the possibility of tariffs is really the most important thing. Uh, and that's kind of what this headline showed then from CNBC, which came out earlier this week, that their folks are less fearful about inflation as a result of tariffs, which is helping bring some of that down. But then in another article that came out today, basically from Bloomberg, said the folks are going to be waiting on the Fed's decision all summer long because some of it has been a bit mixed as far as inflation goes. So what they expect to see happen soon, that's a lot easier to project than what's going to happen down the line. So here's the most recent inflation report for the month from the CPI from the Bureau of Labor Statistics. Headline inflation was 2.4%, with food being up 2.9%. Energy down 3.5%, but the bigger one that the Fed tends to follow is core inflation. I've obviously said that many times, and that's still at 2.8%, considerably above the Fed's target of 2% in general, but actually down just a tenth, and about a tenth below what they expected core inflation to come in at. Then we look at the 10-year headline inflation rate, just kind of historically where we were. Obviously, we're way off the peak from 2022 for that period of time when it was up over 8%. And really, the 10-year headline inflation rate, again, at that two, it's just kind of been right at 2.5, we've been at about this rate before, uh, just about 6 months ago or so, and then it crept back up into that 3.1 range, and now we're back around again to 2.5 or so, and it's still above the target. So some work left to do there. But core inflation then, as I've said, it's been, it was stubbornly above 3%, just above 3% for several months, coming down a bit, and now that core inflation rate sitting at 2.8%. Again, higher than the Fed's target. They still believe they have some work to do there, but it has been, trending downwards. And the next thing I want to show is the unemployment rate, because I saw a headline a few weeks back that said the Fed has done has hit the target of unemployment, which is, 4.5% or below, better than they've hit the target of inflation so far. Okay, that's not that the Fed's done anything wrong. That's not what the headline was saying. It was basically just saying that they've been able to maintain the unemployment target much better than they've been able to maintain the inflationary target, which means that there's less pressure to reduce interest rates, that the unemployment rate stayed pretty stable and favorable for the most part, and they just haven't been able to get that inflation rate down to 2% yet. And by and large, and I put this up there, and the Fed will come out and say, straight up, their job is not to maintain the stock market or keep, stock prices elevated. And I'm just showing the S&P and the Nasdaq here. Some folks look at the Dow. I tend to look more at the S&P, bigger cross section. There was a big dip in the market earlier this year, early spring, but most of that's actually really recovered back to that peak there that we saw back in early mid-January. So this was this big dip here right after 2025 began was, obviously from tariff fears and sell-offs from concerns that tariffs were going to have, all kinds of terrible impacts. And not that some of the impacts haven't been negative in some industries, but one of the biggest things that the market moves on is uncertainty, and uncertainty with what the tariffs were going to bring, how long they were going to continue, and we still don't know some of that, but some of that's eased. And you can see that basically the market has rebounded with some optimism, essentially, that maybe deals are going to be reached sooner than perhaps they thought, that whatever the carve-outs were going to be. And I guess my point in showing all of that is, unemployment hasn't been really a problem, or there hasn't been too many concerns about it. I have seen headlines around the web and various reputable news sources saying that, there's some weakness showing in the job market, and folks are, facing tougher times finding employment. But so far, it really hasn't shown up as in the data that we've looked at, or that the government puts out. And then stocks, basically, while again, the Fed's job is not necessarily to keep the stock market strong, a strong stock market does help improve consumer sentiment throughout the country, and as well as, companies and potential hiring and everything else. So a couple of charts I'm going to put up here related to the Fed and their meeting minutes. This is what, so the Fed is going to meet here soon, next week actually, to basically discuss the current target federal funds rate, which is this 4.25% to 4.5%. I typically quote the high end. I say 4.5. But if you looked at this, if you looked at what the expectations were for the June Fed meeting 5 months ago, this basically holdings constant was not even was a very small percentage who thought so. And in fact, what's interesting about these projections on what markets think the Fed is actually going to do, for as long as the federal funds rate has been, 5.5%, if you looked 3 months out, pretty much the vast majority always expect that interest rates are going to come down. Interest rates are going to come down. And I show you this December target rate. So there's a meeting the 10th of December 2025. And right now only 3% think that the Fed is going to have the federal funds rate where it is today by December. This is basically what June looked like back in January, that nobody thought that it was going to be held even, that interest rates were going to be reduced. And one of the things I want you to consider, anyone, listening out there on this, is why would, if unemployment stays fairly consistent to where it is today, and even if let's assume that inflation is brought down to that 2% mark and markets stay relatively strong, uh, why they're probably not going to drop rates. I mean, why would they suddenly drop rates once the target is hit? The incentive to drop the federal funds rate and thereby indirectly, but drop the interest rate is if they think growth has been slowed to a point that action needs to be taken. If growth stays relatively strong, if the unemployment rate stays right in that target range and wages are increasing at a healthy pace, et cetera, there isn't going to be just this reduction in rates because the target was hit. There's going to have to be a reason for that to actually happen. There's going to have to be weakness in an area of the economy that that justifies a rate decrease. And so that's kind of what I want to get across here is even if the inflation rate target is hit, which it has not been yet, there's going to have to be some sort of economic indicator or some economic weakness that they're trying to compensate for with a rate decline. So my obviously I'm with the folks who finally are saying that they think that the federal funds rate is going to stay there by interest rates are going to basically remain unchanged by Fed's actions for June. And I would be of the group who also thinks, and it's about 20% or so right now, who thinks that there won't be a rate change in September either. I don't believe that that's the case. What would But that said, uh, with what's going on with tariffs and trade policy nationally, obviously a lot of things can change between now and then. And so maybe some of the folks are betting on that there uh, will be a big increase in tariffs or something like that, and they're concerned about inflation in the future. But based on the data that we're seeing right now and what's essentially transpired over the last 6, 8, 9 months, there really isn't anything that we see looming on the horizon outside of trade policy that would dictate that, hey, things are weakening and we need to hurry up and drop interest rates to basically stimulate growth. So that's kind of where it stands. I think that we're probably going to see mostly a hold even or the Fed, a wait and see attitude until some area of the economy dictates that a change is necessary. So that's all I really wanted to talk about again was what's going on with rates there. And so with that, I'm going to stop sharing. And I believe this is I'm normally not last, so but I think this is the point where we turned it over for questions.
That's about right, Brian. One of the things that I was thinking about as you're talking about the macro economy, thinking about end prices, we did see a bit of a dip in oil prices, WTI prices last month. That led to some statements by those in the oil industry, North Dakota oil industry, about a possible relatively minor decline in the number of rigs or fracking crews out. We've seen prices recover since then. It's interesting because folks have to plan with the information they have, but it is changing, and I think that from day to day, and certainly over the last few weeks, that things seem a little bit more certain across the economy. But that's just something that I need to mind.
Yeah, and the biggest and that energy decline is the biggest reason that headline inflation has actually declined down to 2.4%. That's the bulk of the reason why. And that's again why when I say that the Fed focuses on core inflation more, it's that volatility of food and energy prices. Something could happen. I'm not an expert in the energy industry by any stretch, but something in the Middle East or whatever drives energy prices back up, and all of a sudden headline inflation goes back up. And so that's why they strip that out.
Yeah, and just by chance that you mentioned that, if anyone's been following the news, there's been some hints that there might be some interaction between Israel and Iran in the next few hours. So that would definitely impact a variety of things, including energy prices.
Yep, and that's a fact.
One thing that I did fail to mention when I was talking about fed cattle is Frayne mentioned the WASDE report came out today, and they forecast fed cattle prices for this next year And kind of unprecedented is the last month's prediction was 214.51, and they raised that to 221.51, $7 increase in their forecast for this year, which I'm not sure I have ever seen USDA change a forecast that much. Interesting times in the cattle business.
For sure. Yeah, it makes me think about hedging and price management and all of those things.
Well, and that lends into something that I was discussing last week at Stockman's and other venues is the high, and we talked about it too back in 2022. The higher these prices get, if you assume 10% swings are common, let's say, the higher the price gets, the bigger a 10% swing is in the dollars. So in the case of, we all remember when soybeans were $15. A 10% swing on $15 soybeans is $1.50. A 10% swing on $9 soybeans is 90 cents. And so the bigger these numbers get, if the percentages stay roughly the same in terms of the volatility, then the actual raw dollar amount is a much bigger swing. So it stands to reason, like what Tim was saying, and that's what I've cautioned folks about, is the bigger these numbers get, the higher the dollar swing may be. And since we operate on margins, so to speak, and we talk about dollars per head and things like that, those swings get bigger and bigger as those numbers get bigger.
Mm-hmm. Yeah, and it makes me think too that the more uncertainty or volatility, there's this risk premium in the market, and so it, that can be more on a variety of folks, changing behavior, possibly slowing things down.
I think there's a question for you, Dave.
Oh, wonderful. Great. So the question is, when do you think they'll go forward with the 45Z program? So I'll kind of take that or move forward with that under certain understanding. Again, so 45Z, clean fuels production, tax credit, paid to the producer but can get to the farmer. I'll take this as likely being related to rolling out something for the farmer on that production side. Again, because most of the legwork has been done for the biorefiners. There's still additional things to refine and to do, but they're able to participate. If we just think about the traditional process, the law passes, regulatory or the assigned agency has to build out a proposed rule or regulation, essentially describing what they're planning to do, have that out for public comment, and then make a final decision. The Inflation Reduction Act has now been on the books for a few years, and the regulating agency, which happens to be the IRS because it's a tax credit, there's yet to be a proposed rule for those farm level practices. We did see in January information, but it really wasn't part of the process. So USDA released something, EPA, DOE, IRS, but until it actually takes that official form, it can't be finalized. And so when might they pick that up? I don't know. And I think the best thing would be if someone knew. I mean, there could certainly be folks working on it at USDA right now today. I don't know that. It also might be moving a little bit more slowly. Just looking at timing, from kind of a production standpoint, sooner rather than later would be better. But if we're talking about some of these practices, we got the crop in. I don't think it's going to change much until harvest, and maybe even until next year when you might see some of these considerations. I don't know if USDA or anyone else takes that into consideration. I would see this again. I see what the House did as a signal of support for agriculture and biofuels specifically. Does this mean that the ball is rolling and there's a little bit more momentum? It's just really, really tough to tell. And there are, and actually go back to the language that was used by USDA in their document that they shared, again, not a proposed rule, really didn't have a lot of the meat that most folks were expecting. I mean, we've done a lot of work on that. We have a GREET model or two built out. We have all of this research to support it. And it really only kind of took like a small step forward, and it wasn't even the official proposed rule. So there's still some way to go. They did ask for comments on that, and those comments were due, quite a few weeks ago. It'll be interesting to see if they release anything, say anything. And again, they might be working on a proposed rule right now. I'm just not aware. Does anybody have any last comments? All right. Well, otherwise, I want to thank everybody for coming. Thank you, Brian and Tim, for presenting, and Frayne hopefully is driving safely from wherever he was in Wisconsin. We will see you next month. It'll be Thursday, July 17th. So a few weeks from now, and we'll see what happens between now and then, and what we think will happen when we hit the 17th. Thanks.